Good afternoon, everybody. So there are a couple of news, especially after U.S. Treasury to double the size of its buyback and the gold on the headlines. So let's discuss about gold today. And gold surged sharply following the unexpected decision by the U.S. Treasury to double the size of its buyback operations for long-dated Treasury securities. The announcement triggered an immediate reaction across financial markets. The 30-year Treasury yield fell sharply. The US dollar came under pressure and gold gained more than 4% in a single session. This move is particularly important because elevated long-term Treasury yield had been one of the main factors limiting gold upside potential. When bond yield rise, the opportunity cost of holding a non-yielding asset such as gold increases. Therefore, the sharp decline in long-term yield immediately created a much more favorable environment for precious metals. There is also a broader issue behind this market reaction. US government debt, with total federal debt now above $40 trillion. Investors are becoming increasingly sensitive to the cost of servicing that debt and to any measures aimed at stabilizing conditions in the treasury market. The latest buyback decisions once again brought this issue back into focus. At the same time, geopolitics continues to provide additional support for gold. Uncertainty surrounding the Middle East, tensions involving the United States and Iran, and the absence of a clear path toward sustainable de-escalation continue to preserve demand for gold as a defensive asset. Now, let's turn to the technical picture. The key area for me is 4,360, 4,370. And this is particularly important because it represented the upper boundary of the broader 4,041 and 4,370. It was a traded range that had contained gold for several months. Yesterday, powerful impulse pushed gold decisively above this range, meaning that we are now potentially witnessing a breakout from a prolonged consolidation. But the next market direction may be even more important than yesterday's move itself. Yesterday, gold had a very strong fundamental catalyst. Now we need to see what happens on a quieter, news-free trading day. If buyers can keep the price above 4,370 and the market established itself above the former range boundary without additional fundamental support, that would provide much stronger confirmation that the broad breakout is genuine. In that case, we could begin talking about the formation of a new bullish phase rather than simply an emotional reaction to the Treasury announcement. However, if gold fails to hold these levels and falls back below approximately 4,367, yesterday's move could turn into false breakout. In that scenario, the market would effectively return to the previous 4,041, 4,370 range, and the broader consolidation structure would remain intact. So the key question now is no longer whether gold was able to break above resistance. It already did. The real question is whether the market can hold about 4,360, 4,370, this key level. So, and after the initial news driver impulse has faded. So, that reaction could determine whether yesterday's rally market can hold this level and marks the beginning of a new bullish trend or simply another temporary breakout from the broader consolidation. So here the advantage for gold if it holds 4,360 level, and it might be even movement till 5,000 if nothing will change in fundamental factors.